Many of the world's best investors have been buying into the market while most other investors on balance have been selling. Despite the 2023 economy looking pretty shaky with high inflation, the Federal Reserve raising rates, and the stock market suffering over the past 12 months or so over this time period. For instance, after receiving much criticism for being too passive in the market in recent years, Warren Buffett dumped a huge sum of money into it in 2022. Super investors were buying into the crash of 2020 as early as 2008 and as late as 2001, so this is not an isolated incident. That's right, it happened to me too. That was convincing to them, too. This tactic of heavy investment during economic downturns has proven highly successful in retrospect. However, if you follow these guidelines, success is guaranteed. Fortunately, we have Mohnish Pabrai, a student of Warren Buffett's who is close with Charlie Munger and who once forked over $605,000 for lunch with Buffett. The good news is that Mohnish recently elaborated on these guidelines for successful investing. Welcome to Financial Fortune, the channel where we provide you with expert advice on how to navigate the world of finance. How to use the 2023 recession to get rich. While a recession may sound like bad news, it can actually provide unique opportunities for those who know how to capitalize on them. So, without further ado, let's dive in. The secret to finding great stocks during recessions. And the first is searching for businesses that have a sustainable competitive advantage, which is important in these times of high inflation and economic weakness.
Let's say you have some small city in England and it has no Thai restaurant, for example. And someone looks at it and say, yeah, I think Thai restaurant do really well here. And they open a Thai restaurant and they do really well and they're full all the time and they can charge premiums versus London and other cities. That is going to attract more people and more entrepreneurs to open Thai restaurants until eventually the economics of the Thai restaurants in that small city may be no different from other parts of England. The nature of capitalism is such that if someone builds a better mousetrap, which, grows a company and generates high returns on equity and very profitable and so on, they have a target on their back. And in general, that will attract a lot more competitors to enter your space. And they'll try to chip away at whatever advantage is there. Now, sometimes what happens in capitalism is we get aberrations. And when this pharmacist started the Coca-Cola company, he had no idea what he was on to. And no one could have imagined that Coke would end up being the brand it is today. And actually, quite frankly, there's nothing particularly magical about Coke in the sense that they say they have the formula locked up in some bank vault in Atlanta. But it's really easy to clone Coke, and several companies have done that. And when Pepsi introduced the Pepsi Challenge in the 1980s, they basically gave people 2 colas to drink with no brands on them. And they said, tell us which one is better. And most people preferred Pepsi because it was a little sweeter. And then after they took the test, they would tell them, oh, by the way, you preferred Pepsi. But if they presented the 2 drinks to most people with the brands, Coke and Pepsi, most people would prefer to take Coke. And so Coke's moat is, if you look at it kind of objectively, it really doesn't make any sense. They have a product that can be very easily cloned. They have competitors in many cases who have better products, but a brand got built. The nature of capitalism is that moat is very likely eventually to get filled in. So if we go back in history and we look at businesses that have survived and thrived for a long time, very few businesses that are founded make it past their first year. A few will make it past their 5th year, and even fewer will make it past their 10th year, 20th year, 30th year. It just keeps going down. When we look at businesses that may look dominant today, our job as investors is to project what these businesses may look like 5, 10, 20 years from now. And that is a very difficult exercise because you have all these marauding intruders who want to take away your moat who want to take away those profits, and they're continuously coming at you. That's what makes this a fun and exciting endeavor from my point of view, because trying to figure those things out is not that straightforward. So one of the arrows in our quiver as value investors is patience. So in general, we don't really have, for the most part, an information edge. So if I'm looking at a business, there's not much I'm going to be able to come up with about that business that a lot of other people haven't figured out or are capable of figuring out. So the information edge, for the most part, doesn't exist. Then there can be another edge, which is an analytics edge, which is two individuals have the same information, but one person is able to look at that data and come to conclusions that are different from the other person. And so an analytic edge can be a real edge. But even that is difficult because there's a lot of smart people looking at a lot of companies. The one edge that is probably the strongest is the time horizon. And even Jeff Bezos says that a lot of his competitors are focused on the next 1, 2, or 3 years. And he said that Amazon always took the approach of looking out longer, looking out 5 or 7 or 10 years. And he said that when they looked out longer and they invested with that longer time horizon, they got an edge. And they were willing to make investments where they knew that the payoff is not going to come in 3 years. So I think, yes, the ability of an investor to think longer term. And this is one of the reasons why the index does so well. The index is too dumb to know that it owns Microsoft. It's too dumb to know that it owns Alphabet. And it's too dumb to sell these things. And it keeps these things endlessly forever. You look at the S&P 500 index, for example, which is 500, for the most part, great businesses. And every year they might take 1 or 2 businesses out and replace them with 1 or 2 new ones. But usually the ones they take out are not the ones that are climbing. Like recently they removed General Electric from the Dow Industrial Average. And if you look at the Dow Jones Industrial Average over time, in general, you get rising stars going in, and you get kind of companies that are kind of long in the tooth and have passed their prime being taken out. The S&P 500 would hold an Apple or a Microsoft or Amazon or Alphabet for 20 years, 30 years. And that type of holding period on these great businesses can be a great edge. The second approach is where you identify a great compounder that, because of people not willing to look at the right time horizon, then you can look around the corner. You could pay what would be either a reasonable or even an expensive looking price and end up with a great result. I think you could have paid any multiple for Microsoft when it went public in the 80s, almost any multiple for Walmart when it went public in the 70s, and you would have still done extremely. So if we have a crystal ball that can tell us what a company might look like 50 years from now, 30 years from now, then, we could buy something at $1 billion market cap and it might become 200 billion. There are very few businesses in the universe of listed companies that would qualify as great businesses. Probably, I would say less than 5% or 3% of listed companies would qualify as great businesses. If you find yourself in the very happy situation of fractional ownership of one of those businesses, hang on for dear life. And this is one of the biggest mistakes I've made over time. Guy owns a stake in Ferrari, thanks to Mohnish. Thank you, Mohnish, for giving Guy the Ferrari stake. And Mohnish doesn't own Ferrari. And when I made the investment in Fiat Chrysler in 2012, when the market cap was 5 billion and their sales were 140 billion, Fiat Chrysler was trading at less than 4% of revenue. Okay, it was just the equity was, and 80% of Ferrari was inside that 6 billion. And plus there was all the Jeeps and Ram and Maserati, everything else in there. And at that time, Pabrai funds owned something north of 1% of Ferrari when I looked through the Ferrari stake. And we made a lot of money on that investment. And one of the dumbest things I did was Ferrari looked optically expensive to me. And I sold, and we would probably have 3 times that amount of money if I just kept the position. And like Charlie says, old too soon and wise too late.
Remember, while a recession can be a challenging time for many, it can also present a chance to build wealth and financial security. Be sure to subscribe to our channel for more financial advice and hit the notification bell to stay up to date on our latest videos. Thanks for watching, and we'll see you in the next one.